thank you, Nia and Kai, for having me this Friday. It's great to present in front of an audience that's super familiar with decentralized finance. So this paper is joined with my co-authors Alfred Lehar from HESCAIM from Calgary and Christine Parlou from Berkeley. And it's a paper about fragmentation, but it's really a paper about economies of scale in decentralized finance and whether we do need to have different markets for different clienteles. So what we're doing, we're looking at the Uniswap V3 setup, the AMM, to study what effect do costs, in particular fixed costs, but also variable costs, have on liquidity supply. And then we argue that having these multiple pools on Uniswap V3, where different kind of liquidity providers can mint liquidity, is actually beneficial, because it sort of like allows a more fine-tuned liquidity supply schedule. Why study an AMM to begin with? Well, they're getting bigger and bigger. They're processing a large volume of transaction. When you compare them to Binance, and I'll have a graph in a couple of slides, they actually seem to provide more liquidity, at least for the major pairs. It's an interesting model for real-world assets to migrate to. For example, the Project Mariana of BIS. And especially important for us, it's very clear cut who's providing and who's supplying liquidity, because you can demand liquidity for limit orders, for example, but here you cannot take a position for minting liquidity. So DEXs are big, and they sort of had a peak around 21, 22. They're still quite important, with volume around 100 billion a day. Uniswap, in particular Uniswap V3, is the dominant player in this space, and that's who we're going to be focusing on. And they seem to have substantial liquidity. So if we're looking at the top pairs, right, at ETH against USDC and, well, the reverse, USDC against ETH, on Uniswap V3 and centralized exchange, we see that market depth at, plus minus 2% around the midpoint, plus minus 6%, seems to be one order of magnitude higher on the most liquid Uniswap pool than on essentially most centralized exchanges. So they're doing something right in this sense. Now, this is probably common knowledge for this audience, but it's worth mentioning that there are three versions of Uniswap: V1, V2, and V3. In all versions, there are common elements, like our agent, like participants will choose whether to mint liquidity, to supply liquidity, or to demand liquidity for swaps. The trade prices are automatically computed through the AMM, or the automatic market maker, and there's no spread. Only revenue for the liquidity supplier is a fee that's proportional to the traded volume, and that's paid by the liquidity demander. What does V3 bring new? Two things. First of all, it allows for trading fragmentation. So each asset can trade on multiple pools with different fee levels, either 1, 5, 30, or 100 basis points. And there's also concentrated liquidity, which means that, in contrast to V2, where liquidity providers had to provide liquidity over the entire price interval from 0 to infinity, now you can concentrate your capital and say, I want to provide liquidity in a tight price range, which means there's going to be less price impact for demanders. So that's good. So the V2, right? When you provide liquidity on V2, you kind of condition on price. So you're essentially providing for liquidity for every positive price. On V3, you can set a, sort of like the limit orders, you can set a minimum and a maximum price, and you're only providing liquidity in that range. And if you're aggregating positions with different price ranges for multiple people, you can get to something that's relatively close to how a limit order book works, right? You can get the slope of liquidity. Now, the counterpart of this, and why this becomes relevant in our case, is that if you have liquidity over a certain price interval, it's possible that if as price evolves, your liquidity will actually sort of be out of range. It will not include the current price, which means you stop earning fees. And if you do want to earn fees again, you might need to actively manage the position, sort of burn, cancel this position, and mint it again at some other price interval. So on V3 as opposed to V2, there is this incentive to do active management of liquidity.
Can I ask a
Yeah,
question?
yeah.
I guess you will get more to it later, but can you say just something about um in terms of like efficiency as a liquidity provider, it's better to let's say you have a budget, it's better to put all the positions in one bin, like the middle chart, or it's better for you to do kind of this histogram, so you split your positions um, in terms of the liquidity in the liquidity provider side.
Um, Now, when I think of this chart here, number three, I think of like the aggregation of like multiple liquidity providers.
Mhm.
From a modeling perspective, this is much simpler. Uh, but if you want to sort of tightly manage your adverse selection risk for various price levels, then
I see.
this might actually be better.
I see.
We're actually not looking necessarily at price ranges per self in this paper, but sort of translating the findings of these papers, the more granularity you have in the liquidity supply, typically, the better you can control the risk. I think that would be a takeaway.
Okay, nice, thanks.
Yeah. So managing liquidity, especially actively moving your price range, is costly. So this is sort of a simple schematic of how the liquidity pools work. You have liquidity providers, they will add tokens to a liquidity pool, right? So if you want to provide liquidity in USDC ETH, you will typically add both USDC and ETH. A trader will come and, for example, want to buy ETH. They will add USDC to the pool and they will take ETH, and then they will pay a liquidity fee to the liquidity provider, which is the compensation for providing liquidity, right? There's no other spread in here. And then everybody has to pay gas costs to the validators, right? The former miners, now the sort of the stakers in Ethereum or in other blockchain protocols. So every time you are adjusting your position, canceling or minting, you have to pay the gas fee. So that makes active management somewhat costly. And what we'll show in this paper is that the cost is different from different kind of liquidity providers. Now, these gas fees are non-trivial. So this is a plot of the gas cost for transactions that are basically just mints, just liquidity mints, and especially US dollars. It gets back in 2021, 2022, it could be over $100. More recently, it's $5, $6. But if the network is congested, it can spike up quite a lot. So these are non-trivial costs, and importantly, they vary. They vary a lot across time, even in our sample, in our 2-year sample. So we're going to use this variation to actually tease out empirically the effect of fixed cost on liquidity supply. Now, why we get excited about LPs on a decentralized exchange in the first place? First of all, it's a very good laboratory to study how liquidity is priced, because everybody who mints liquidity actually wants to provide liquidity, as opposed to very complex strategy that might or might not involve limit orders in traditional markets. And importantly, they're designed to be passive, or at least in the context of V2, liquidity provision was designed to be fully passive, which opens up the space for non-professional liquidity providers, right? For retail liquidity providers, for example, to participate, because on limit order markets, we know in order to be competitive, you need to co-locate with the exchange. You essentially need to be very technically sophisticated, right? Like the high frequency traders. But on DEXs, at least in the original vision, you can just set it and forget it like you would do in an ETF. On V3, the story is a little bit different, and that's sort of where we're trying to get. Because managing liquidity, it becomes costly. First, you have the gas price for interacting with the blockchain. Second, even if you believe the gas price is going to become negligible, there are going to be, layer two solutions that are going to make this very, very cheap. If you're a small trader, if you're a retail trader, there's still significant fixed costs because you can't be online and monitor your position all the time. You might not be able to, write algos to do that. So there's the time and effort to monitor the position, right? So in the end, what this paper is about is really about the cost of liquidity provision. And, this sort of harks back to the beginning of microstructure, to, the late 60s, the early 70s, whether do we economize properly the costs or not, and whether the Uniswap fragmented pool structure actually makes sense, or it's efficient. So we're going to have a model, and then we're going to have some empirics to sort of zoom in into liquidity providers, and we're going to find that there are clienteles. You have two types of liquidity providers. You have small liquidity providers, which we sort of think they are, close to retail providers. These guys are passive. They have typically low deposits in the pools, and they manage them less often to avoid paying gas costs. They will sort of step back. They will be in the high fee pool, right? If you imagine there's a low fee pool and a high fee pool, the low fee pool is going to be very active. The high fee pool is costlier for liquidity demanders, so they're not going to trade that much. The fill rates are going to be low, but once they do, they're going to get the higher fee. If you're a large liquidity provider, then you're going to be where the action is, in the low fee pool, where a lot of trades are being churned, and you will actually update your position much more often. And what we show is that this segmentation is actually efficient, because otherwise these small liquidity providers will not be able to compete at all. So they might be crowded out of the market altogether. So we give them a way to be, in limit order book language, to be sort of at the back of the book, but still get the revenue.
Um,
And
there is
yeah.
a question in the chat, and they ask if it is the main idea similar to the lever paper. Do you know this paper, Marius?
Yeah.
And if you can say what is like the difference features in your model that we need to have in mind, or
So the lever paper is really about asymmetric information in some sense as a cost. We're really talking here about fixed costs. So with asymmetric information, there shouldn't necessarily be a clientele effect, because everybody's sort of affected in a similar way by the fact that faster or smarter arbitrageurs trade against you. What we're documenting here is that there are differences across liquidity providers that are driven by fixed costs. That being said, in the most recent version of the paper, and I'll get to it at the very end, even if we don't have adverse selection in the model, we do compute lever, and we do sort of comment a bit on the difference between this cost on high and low fee pools. But to show that the main channel of the gas price is 90%, and lever maybe is like 10% of what we're documenting. But that's a very good question. That's a very good paper, and we talked very extensively with the authors of the paper along the way. Okay, so there's a growing and large literature on decentralized exchanges that we're contributing to. Most of the papers deal with the AMM. Now, more recently, there are papers that deal more with a whole host of microstructure questions, like price discovery, for example, or liquidity provision in Malino and Park, or like Nir and Kyle have a paper on preferences for security. And we're also dealing with the more classical microstructure literature on optimal routing, because where do you actually put short on the high and low fee pool? That's going to be a key question. And make-take fees, to the extent that you can see the liquidity fee as equivalent to a make-take fee that's paid by the demander and received by the supplier. Okay. If there are no other further questions, then I'll jump into the model. It's a very simple model. We have a single token with an expected value V, with actually value V because the value is not really changing. Trading on two liquidity pools against the numeraire. The liquidity pools have heterogeneous fee. That's going to be fee H. That's larger than fee L, and both the fees are positive. And every time you're interacting with the pool, you have a fixed cost gamma, which you can think of it as a gas fee, and empirically, that's exactly what's going to be a gas fee. Or you can think as any sort of fixed cost from liquidity provision, like developing the software, like monitoring the position, etc. We're going to have all the continuum of liquidity providers. We want heterogeneity.
Can I ask a question?
Yeah.
So actually, about this for fixed cost, I think like what you have in mind, because I think in some sense it could be even greater, and because as I see it in my mind, and let me know if you think the same, is that if I'm let's say a small liquidity provider, and I have only this liquidity is my budget, and now you kick me out of the range. So what I need to do is I need to first withdraw, let's say, only Ethereum, because I now have only one token. I need to trade Ethereum to the other token and then provide liquidity again. So it's kind of, the cost is very high because it includes like kind of, I think, three parts: withdrawing money, trading, and putting money back. Do you have this in mind in terms of like?
Yeah, that will be. We see that, when people mint and burn, there's typically a few minutes in between them. So they are different transactions. They don't mint and burn in the same transaction most of the time. But everything is going to be proportional to some extent to the gas fee, right?
Yeah, for sure. Yeah. I'm just saying that it's that in some sense the fixed cost for small traders, if they don't have more liquidity available, it can even be more.
Yeah.
It can be very, very high.
Yeah, if you're like, when I showed you on that first graph, right, where that's basically the gas cost of one transaction, and what you're saying is that, well, to actually rebalance, you need 2 or 3 transactions.
Exactly.
Which I think it's a fair point. Yeah.
Okay.
So it could be higher. So for the purpose of the model, let's think of this fixed cost, the entire cost of rebalancing. So not just the gas cost with one transaction, but the gas cost for rebalancing. So we have a continuum of liquidity providers with various endowments, what we're going to denote QI. These guys are risk neutral, and there's actually no risk in the model to begin with, but they have linear utilities. And the QI follows a bounded Pareto distribution between 1 and this capital Q. So what do we want to sort of get at with this Pareto distribution? We want to see that there is a large mass of small liquidity providers that are in the market, many retail traders, and lower mass, like a smaller number of really big ones. Now, this is not, the exact functional form is not crucial for the results, but it, help us get some sort of nice close run solution with this setup. Okay. And on the other side of the market, you have 2 kinds of liquidity traders, right? So these are going to be the ones that initiate the swaps. You have small liquidity traders. So these guys are infinitesimally small. They're going to arrive at a constant rate, basically a flow, theta dt, and they are going to go to the low fee pool, right? All these liquidity demanders, they're rational in the sense that they will go to the low fee pool, and only if the low fee pool is exhausted, they're going to go to the high fee pool. And because the small LPs are very small, they always will go to the low fee pool. And from time to time, you can, with a Poisson process, with intensity lambda, you can have a large LT arriving. When the large LT arrives, they consume all available liquidity. So we assume this theta is large enough that they just go to the both pools. So this is something that's inspired by the JF paper of Foucault, Cardan, and Kendall, because what they really want to get here are liquidity cycles, like basically round trips up until you need to readjust liquidity. So on the high fee pool, the liquidity cycle is very simple. It corresponds exactly with the arrival times of the large traders. That's the only time any trade gets done in there, and that's the only time when liquidity is exhausted. On the low fee pool, you can have two kinds of liquidity cycles. Either you have this flow arrives at a constant rate and sort of exhausts the pool, and then they say, oh, we have to rebalance. And that's when the liquidity cycle ends. Or you have people flowing, and at some point, in the middle, the large LT arrives, and then that ends the liquidity cycle there too. All right, so you have two kinds of liquidity cycles on the low fee pool. And because there are these fixed costs, there are no incentives for liquidity providers to actually rebalance at any point in the middle of a cycle. They will just do so when all the other token has been transformed. Now we, to keep things tractable and easy, we abstract from any sort of constant product AMM. Everything is linear, so all the trades occur at V. We don't have, a spread. We just have the liquidity fee. So all the trades come at V, and then the liquidity fee is posted. We don't have, at least theoretically, we don't have a measure of adverse selection. We would argue that it's even difficult to know what adverse selection means in this context because there are no cash flows or no true price discovery in some sense for most of these tokens and no clear value benchmarks. On the empirical side, I'm going to look a bit at lever and differences in lever, and I'm going to comment a bit on that. But we don't have them in theory. Now, the main endogenous variable here will be the duration of the cycle. And that sort of determines how often people need to rebalance. On the high fee pool, the duration of the cycle is simply 1 over the arrival rate of the large guy. That's the only time when the cycle ends. On the low fee pool, well, it's going to be 1 over lambda, right? That's the first condition of ending the pool when the large guy arrives. But it's going to be shorter because the liquidity cycle can end earlier if the flow exhausts the liquidity, right? And by how much? By a number that's proportional to how much liquidity there is in the low fee pool. If there's a lot of liquidity in the low fee pool, then the flow of small traders will exhaust liquidity slower, right? It's going to take longer for all the liquidity to be exhausted. If there's very little liquidity in the low fee pool, then the cycle is going to be shorter. Liquidity is going to be exhausted faster. And if you're a liquidity provider, you have to choose between doing nothing, so staying out of the market if you simply cannot afford providing liquidity, going on the low fee pool or going on the high fee pool, and you're maximizing your profit per unit of time. Right? So the unit of time is going to be essentially, we're going to divide the profit by the duration of a cycle, and the profit per cycle is simply going to be your endowment times the liquidity fee, right? Because you're just waiting there until the entire endowment is consumed and everything is pro rata and grows at the rate of the liquidity fee. And once you're done, you need to rebalance either for 1 or 2 or 3 transactions, and you pay the cost gap. Okay, so the trade-off is going to be, do I want to be in the low fee pool? The low fee pool is going to have more trades. We're going to show that in a second. It's going to have more trades. So I'm going to get the fees faster, but at the same time, I will need to rebalance faster. Or do I want to stay in the high fee pool and accept that I'm not going to trade as often? When I trade, I am going to get a higher fee, but at the same time, I'm saving a lot on rebalancing cost. I can be more passive.
Can I ask a question?
Yeah.
So yeah, it's very interesting, but I want to make sure that I get it right. So if we put rebalancing cost aside, so let's assume that the cost is zero. So I thought that in terms of like equilibrium predictions, the high liquidity, the high fee pool going to have less liquidity than the low fee pool, and by competition, in the end, it should be that the revenue that you are indifferent between putting your next liquidity in the high pool fee versus to the low, right? In terms of kind of like, because if not, you're going to end up with only one pool in the market. So the kind of the.
Let me see. So
And
if the gas cost is zero.
Yeah.
Yeah. I think if gas cost is zero, a lot of the time, you're going to end up with a lot of competition on the low fee pool.
Exactly.
Yeah.
But I mean, like in the equilibrium, we can think about it in some sense that people need to be indifferent between providing the next liquidity in the high or the low pool because they accept that in average they will earn the same from both. But now it's interesting what you're saying, that what they also need to have in mind, that given that small pools are small fees pool are more competitive and there is more trades there, you need to rebalance your position more often. So there is additional benefit to be in the high pool fee.
Yes. Yeah. So
Interesting.
if you
Okay.
like
I can.
Yeah. You can see that's the main reason why this actually endowment matter. Like if you set the gamma to zero, you get rid of this term here, and then you're comparing this and this term, basically your endowment will not matter. I can cancel it out, and everything that's going to matter is the fee versus the duration of the cycle.
I see. Okay.
So you're not necessarily going to have fragmentation in this case.
I think
Once you put a gamma, you're gonna have a marginal guy.
Yeah.
That's going to be the marginal trader where the market splits.
Okay, super interesting. I think also it's makes sense for the previous comments about like the interesting added value of the model, which is now I get it.
Yeah.
Yeah. Okay.
Like the model is really about fixed costs, or
Yeah.
that's how we're trying to pitch it. It's a model about fixed costs.
Thanks.
Sorry, I'm
All right.
trying to
Yeah.
clear my mind here. So we're not considering any price movement from the trade, right?
No.
We're always considering
No.
it's going to be the same price, so there's not such thing as a something trade on the big pool. It's less likely to move the price around versus in a small pool, it's more likely to move the price around. So the trade comes in a way that it always balances back to that price point equals to V.
Yeah, I think you can have that in mind. Like we're not thinking of these liquidity traders as being informed in any sense. So if you would have any price impact, that, as you say, it will be, there will be arbitrage away. It will be re-arbitrage to V. So the only thing that will happen then is you're scaling the fee by 2, right? Because you're going to earn twice the fee on one way and on one two. So we're not, for simplicity, we're not saying, well, we're earn twice the fee, but maybe we should say that. We're saying you earn the fee once and then yeah.
Okay, sounds good.
But there's no informed trading. Even everything is uninformed, so you're not gonna get money from price impact. as a liquidity provider in this case. Okay. So the main trade-off here is you earn a higher liquidity fee per unit of time in the low fee pool, but you're in the high fee pool, you rebalance less. And then what happens in equilibrium, there's going to be a threshold. In most cases, there's going to be a threshold that every liquidity provider that has an endowment above this threshold, they're going to go to the low fee pool because for them, the fixed cost is relatively low, so they can afford to rebalance more often. And all the liquidity providers with the endowment below the threshold, they're going to say, well, I don't want to rebalance that often. So they're going to go to the high fee pool and they're going to accept it to have lower priority. Now, we don't have a closed form solution, but we can characterize the threshold in a number of ways. We can solve for the equilibrium liquidity on the low fee pool and the high fee pool, which is basically the aggregate endowment of everybody with an endowment above QT, above the threshold, or below. And you might have some people, you might have another threshold that everybody with an endowment below this Q underbar threshold just stays out of the market, right? Because for them, the fixed cost is prohibitive. So in the end, if you're like simulating this distribution, you're going to have something like this. You're going to have potential liquidity providers that have very low endowments that can simply not afford the gas fee at all, so they stay out of the market altogether. You have the sort of intermediate endowment liquidity providers that want to benefit from the saving in the rebalancing costs, and they go to the high fee pool, and then everybody who's really rich in some sense, like the big whales, they will compete on the low fee pool, right? So in the end, what we expect empirically, we expect to see more endowments, higher endowments, higher min values on the low fee pool than the high fee pool, and potentially we expect to see more liquidity providers on the high fee pool because that's where the mass of retail traders is going. And in terms of equilibrium, we're trying to plot the equilibrium values. You see, as you increase the gas cost, if the gas cost is very low, then you're going to have everybody going to the low fee pool, so everybody's going to be competing there. Because if you increase the gas costs, you're going to have fragmentation. Some people are going to want to avoid economies of scale. They're going to move on to the high fee pool. And if the gas costs are very high, everybody is essentially going to be on the high fee pool. Okay, and the higher you make the endowment, the more fragmentation you will have, because actually the size of the liquidity pool will increase. So there's more scope for differentiation. Now, everything I said here is sort of like a positive argument of what will happen. One thing that we've been interested lately in the latest version of the paper is see, is this optimal? Is this an efficient outcome to have the fragmentation? So the natural benchmark, right? Because fees are a transfer. So it's unclear whether we should care about fees per se. One natural benchmark is to have full participation, to have all the liquidity providers in the market, which means that we need to set a fee that's higher than the fixed cost, right? If you assume that we normalize the smallest endowment to 1. So if you set the fee high enough to cover the fixed cost for everybody, then you have all the maximum liquidity provider participation. So everybody gets a piece of the pie, but at the end of the day, it sort of defeats the purpose for liquidity traders because they have to pay these very, very large fees. So then at the end of the day, we came up with a benchmark that resembles the implementation shortfall from the classical Perl 1988 paper. So we're looking from the perspective of the large liquidity trader, what are the costs? So first of all, are the fees that they pay, right, on both the high and the low fee pool, proportional to the liquidity that's available there. And then you have unrealized gain from trade. So if people don't participate in the market, then when the large liquidity trader comes, they can only trade up to the sum of the endowments of the people who participate, and there's going to be an unsatisfied demand. So then it's easy to see that there is an optimal single full fee, right? If you keep a single market and you set the fee too low, then you're going to have this term here dominating because the fee is too low. Not a lot of people would go in. As you increase the fee, more people come into the market, more liquidity providers. That reduces implementation shortfall because it reduces the unrealized gains from trade. But at some point, you're going to have a more than proportional increase in the trading cost, in the pure trading costs. So implementation shortfall would go higher again. So if you want to minimize costs for liquidity demanders, right? Both explicit and unrealized gain from trades, you will find some sort of optimal fee here at F star. So now what we're arguing is that you can always have a fragmented environment that achieves at least this implementation shortfall, if not a lower one. And the argument is as follows. Let's say you have a high and a low fee pool. You can set the high fee pool equal to the optimal single pool fee. So in that sense, you're saying, well, everybody who would have participated in that optimal pool is also going to participate in my two pool system. They're just going to go to the high fee pool and then set a low fee that's somewhat lower than that, right? So by setting the H to F star, you're fixing the optimal participation. And by creating another pool with a lower fee L, you are allowing for potential competition. Some of the larger LPs would just migrate to that pool, right? So you can see here that as you increase the gas costs, right, the implementation shortfall in the fragmented pool is always lower than on the single pool. Well, if the gas cost is too high, then nobody's going to migrate to the low fee pool to begin with. They're all going to stay on the high fee pool, so you're essentially in the optimal single fee pool scenario once again. Right? So what's the main idea here is that having two pools basically allows to control both participation, right? The participation level, which is crucial to determine the unrealized gain from trade, and the amount of level of fields, right? You have sort of two objectives that are difficult to optimize with only one instrument, with only one fee. It becomes a little bit better to reduce implementation shortfall if you have two instruments. One to control the marginal participant in the market, in the high fee pool, and the second one to sort of improve competition across pools. So we argue that fragmentation, in the sense we see it on Uniswap Free, can actually be beneficial. So we wanted to make this like sort of a more normative point. Now, unless there are questions about the model, we can look at the data. So we get our data from the subgraph, from the Uniswap Free subgraph. All trades, mints, burns from the inception of the market from May 4, 2021 until essentially the summer of last year, July 15, 2023, and we include the wallet addresses. We collapse this into like a daily panels. Our proxy for the gas cost is going to be the average of the lowest 1,000 grad gas prices for mint events. So we want to really look at the simple transactions, those that are pure Uniswap mints, and we're looking at the lowest 1,000 gas prices in a given day. Then, of course, we still have a lot of pools, so we're trying to filter them to get economically meaningful one. So pools that are active in more than 100 days, that have more than 500 liquidity events or mints or burns throughout these 2 years, that have an average liquidity balance TVL of over $100,000, and that trade more than 1% of a volume for a pair, right? It could be a pool that's very inactive. And in the end, we get 274 pools in 242 asset pairs, aggregate volume 1.12 billion. The TVL, the total value locked at the end of the sample is 2.53. So you can see that's the vast majority of what's going on Uniswap in these pools. Actually, it accounts for 86% of all interactions with the market. So we really think we narrow it down to the economically meaningful one. And within this subset, there are actually only 32 pairs that are fragmented. And these 32 pairs are 95% of all the liquidity in the 270 and 93% of the volume. And typically trading concentrates across, for most of these fragmented pairs, across 2 consecutive fee levels. So for ETH against USDC, that's going to be 5 and 30 basis points. For something less volatile, like a stablecoin pair, it's going to be 1 and 5. For something that's more volatile, like Curve, 30 and 100 basis points. And then we see a lot of fragmentation, right? You can see here like both pool size and volume. The size of the fragmented pools are order of magnitude higher than for pairs that are in a single pool. And you see something that's very consistent with the model. There's a lot of liquidity locked in the high fee pools, right? At least over our sample. But a lot of activity, a lot of trading volume, it's actually in the low fee pools. I think that was sort of our initial observation.
Can I ask a question? So here the high fee pools are the 30 base point and 100 base point? Or
So
relatively?
for each pair, relatively. So for each pair, actually for each pair day, but pretty much that's the same thing as each pair, we label low fee pool, high fee pool.
I see.
So the main analysis is going to be the low fee pool dummy.
Because what I was thinking is for example, I think the 30 base point pool was initially enabled, and the 1 base point and 5 base point are later enabled in V3, right? So could that be what drives there's more liquidity in the high fee pool because of the liquidity already logged there? And then in some sense the tradings in the low fee pool is not necessarily by choice, but more like by router choice. But that also goes along with the price. It depends on the trade size and then also the liquidity. So I'm not sure if we were, for example, comparing pairwise, 1 base point versus 5 base point, and then the other token is 5 base point versus 30 base point. I'm not sure if that would make a difference if we only compare, let's say, all the 1 base point we say they are low fee, and then all the 30 base point we say they're high fee. I'm not sure if that would make a difference or not.
Yeah, no, I mean we do things by pair.
Okay.
Because every pair will have its specific sort of environment in which they're fragmented. That depends on the underlying volatility of that pair. So we ran this on different sort of time samples too. So I don't think it's sort of the initial part that's driving it. If it was the initial part, you will also see something going on in the volume, right? In the average volume, because that will be set to 0 on a lot of days.
Right.
I have a question.
Yeah.
Second, I have 2 questions. First, sometimes we have more than 3 pools with the same tokens. So what you did in this case. And second, I think there is a little bit heterogeneity in terms of token type. So for example, I think in stable coins, you will see a little different situation, right? So I don't know if you have to say something about that.
Well, you'll definitely see different fee levels for the ones that are active.
Yeah.
So we do have in all our regressions, we do have pair fixed effects that are supposed to absorb some of this variation. For your first question, once we have this filter number 4, that we exclude pools that have less than 1% of volume, we actually don't have anything that's on free pools. There's nothing that's actively on free pools. There could be free pools there being initialized, but one of them is always below 1% of volume.
I see. So
So
basically,
just,
yeah. Okay, I see. So basically, yeah. So in that case, you have like 2 active pools, and you have another one, but it's so small. So
yeah, so that it gets filtered out. So that's
yeah.
what we're doing to deal with that.
Good.
So we keep our labels consistent.
Thanks.
Okay, so then we have more summary stats that we think go in the line with the model. So the average mint, the average deposit size, it's much higher on the Lofi pool. So that's consistent with the Lofi pool being the playground for these large liquidity providers that can actively churn the liquidity. The average trade size, on the other hand, is much higher on the high fee pools. Right? So on the low fee pools, you have many small trades, and on the high fee pool, you just have the large trades coming in. That sort of, let's say, exhaust liquidity or are routed through the pools. This result got a little bit weaker as we updated the sample. You have more addresses on the high fee pools, right? That's consistent with having more retail traders in there. The effect sort of comes a bit for the tail. Like there's a lot of heterogeneity, and there are many more trades on low fee pools than on high fee pools, right? So many small trades on the low fee pools, few large trades on the high fee pools. That's sort of what we're assuming in the model too. So now, if you are looking at the actual regressions for this, and you're regressing mint size, trade size, you see that on the low fee pool you have 73% larger deposits, right? This is in logs. 30% lower trades, but pretty much double the volume and the number of trades, right? You have fewer wallets on the low fee pools, right? That means that there are the few sophisticated players on the low fee pools. They make a little bit more money just in fees, right? Liquidity yield is just fee revenue over TVL. They make 2 basis points more. And something that's not in the model but is consistent with the model, they post narrower price ranges. So they're more willing to rebalance if need be on the low fee pools because they have narrower price ranges. And this is what Olga Klein and Cotters find in their paper across Ether and Arbitrum too. Now, we want to sort of have some more in-depth predictions of the model. So we're trying to see what happens when we vary gas costs. Well, what happens to liquidity deposits? Let's say you start from here, very low gas costs, or everybody is in the low fee pool. As you increase gas costs, people are going to start caring about rebalancing costs more. So they're going to migrate from the low to the high fee pool. After a certain point, some people are starting to be crowded out of the market. So actually both low and high fee pool deposits are going to go down, but the low fee deposits are going to go down at a faster rate. All right. So in terms of market share, you're always going to get an increase in gas costs will reduce the market share of the low fee pool and increase the market share of the high fee pool. And that's sort of what we see in the data. So first of all, we see that low fee pools have significantly lower liquidity market shares and significantly higher volume market shares. And if you bump up the gas price, the low fee pool is going to lose market share, right? Both liquidity and volume. This is talking about one standard deviation increase in gas prices, right? Regardless of how many transactions you actually need to rebalance. So it seems to move in the direction. Now, if you are looking at flows directly rather than market shares, you can see that if you bump up gas prices, you're going to see less activity in the low fee pools, both in terms of the log mints and in terms of the probability that having at least one mint in that given day. This effect is going to be more muted on the high fee pools. And that's because, you know, the high fee pools, if you increase gas prices, well, sometimes you might get migration. So an increase in activity, sometimes you might get people being crowded out, so a decrease in activity. So it's sort of unclear what's going to happen to the high fee pools. And, you know, empirically, we don't see much of an effect. So this is in line with what with the intuition behind our model too. All right, you get this flow. Something that's, you know, important for us was the rebalancing cycles. All right, so the time elapsed from mint to burn, which, you know, unlike, you know, typical limit order markets, this is measured in days or even weeks. And you can see that on low fee pools, the rebalancing cycles are much faster. We're looking at the time for a mint to burn by the same wallet. If you're looking at burn to mint, actually, this happens relatively fast. You can't really see here, but the median is around 10 minutes. So once your position got out of range, you're trying to rebalance within you know, a few blocks in 10 minutes. And typically, when you are burning your position, 70% of the time you're burning because you just got out of range and you want to rebalance, right? So this sort of is evidence of these liquidity cycles. So the liquidity cycles are shorter on the low fee pool, and if you increase the gas price, it actually gets even shorter. So why would that be the case? Well, the gas price increase, then liquidity supply is going to drop on the low fee pool. If liquidity supply is going to drop, then the same sort of flow is going to consume it at a faster rate. That's going to increase the rebalancing frequency. And you don't see an impact of gas prices on the time between burn and mints, right? So this is just the time that you need to sort of like jump back into the saddle and repose liquidity, which has nothing to do with, you know, the liquidity supply. Okay, so the last thing I wanted to show you, since we also had a question about that, is how lever behaves across pools. So that's not in the model, but it's something people were asking us about. So the way we are computing it is very similar to basically like a realized spread form. You look at the direction of the spread of the quantity, the average price of the swap, and then a benchmark price. In the original lever paper, the benchmark price is the Binance price, but we have too many pools to have a proper Binance price for every one of them. So we're looking at two benchmarks. One of them is the pool price immediately after the swap, right? So it's the average price of the swap and the price after the swap was executed. So that's going to capture both temporary and permanent price impact because we don't allow for the arbitrageurs to mean revert. And we're also looking at the pool price 1 hour following the swap, in which case we allow for any sort of good arbitrage to already happen. And hopefully we capture the permanent price impact. So why we're interested in this? Because there could be confounding mechanisms, right? So let's assume that if liquidity fee is higher, then it's costly for arbitrageurs to trade on high fee pools. So we should expect lower adverse selection on high fee pools. And a higher gas fee is actually going to offer better protection for high fee pools too. So when the gas fee is higher, people who are concerned about their selection are even more likely to migrate to high fee pools. And then we should also maybe see some divergence. So this will sort of give you the same prediction as our model. So we want to sort of benchmark them together. What do we notice? We notice that indeed lever is higher on low fee pools, which means that's the first place the arbitrageurs go on. Like if you look at, you know, immediate price impact, that's much higher. That's a bit misleading because there are a lot of like small trades that got reverted immediately. So it's not really capturing the permanent price impact. If you just look at the permanent price impact, it's about 6 basis points higher on the low fee pool. But if we're doing a sort of double interaction between, you know, our main effect, how does gas price impact liquidity and volume shares on low and high fee pools? And if we're interacting this with lever, we see that the coefficient goes in the same direction as our main story, but the effect is much more muted. So we're really thinking that what we're finding comes from the fixed cost and not necessarily through the adverse selection channel, because this is maybe like, you know, 10 times smaller. Another concern would be what's sort of like if we have this difference in adverse selection, if there's a difference in price discovery among high and low fee pools. We're looking at the top 4 pairs where we sort of have enough data from Binance. We see that the average deviation is around 0.6% at an hourly level. But you know, the difference between low and high fee pools is negligible. So they both track Binance prices equally well. And finally, if we're putting together like yields, like revenue versus cost, because I think that would be interesting to do. So let's look at the permanent price impact, right? Computing lever with a 1 hour after price. And we're looking at liquidity yield, which is just, you know, the liquidity fee times the volume divided by the TVL. We see that people on the low fee pool are not breaking even or almost breaking even. They have a revenue around 12 basis points, and the price impact is around 14 basis points. So they lose a bit of money. On the high fee pool, they actually make more money, right? They earn about 9, and the price impact is around 8. So there's small retail traders that are actually better protected against adverse selection. They might actually make money, and for the big players, it's more like a loss leader. That's pretty much what I had. So we had this investigation on economies of scale in a market that's designed for passive liquidity provision. We're looking at fixed costs, and we argue that they create different economies of scale for small and large liquidity providers, with small liquidity providers going to high fee pools where they accept a lower execution rate, but they get higher fee and they have to rebalance less often. Large LPs will be, you know, more active, they will rebalance a lot, and they will tend to migrate towards lower fee pools. But at the end of the day, fragmentation can be efficient. Theoretically, right? You give those smaller players, you give them a market where they can participate in some of the trades, if not all of the trades. And empirically, if you look at costs, informational costs and fees, they actually do a better job than on the low fee pools. All right, thanks a lot.